Another huge bombshell in finance? Dingy Fang's stock value plunges nearly 70% in 5 days. CCP prohibits issuance of 364-day foreign bonds amidst rising local government debt. Recent poll shows that global attitudes have not yet digested the news on China. Apple implements uncommon discount strategy in China to reduce excess stock. It's all covered in today's China Truths. Another huge bombshell in finance? Dingy Fang's stock value plunges nearly 70% in 5 days. This past Tuesday, January 16th, the Hong Kong stock market saw some major shakeups. Dingy Fang International Asset Management Group's Dingy Fang Holdings experienced a dramatic drop in its share price, over 30% on that day alone, adding up to nearly a 70% plunge in just the last 5 days. The investment world is buzzing, saying this could be another massive blow-up in the asset management sector. Southern Metropolis Daily's app covered this on the 16th, saying their reporters tried reaching out to Dingy Fang Group in Hong Kong but hit a dead end. The phone number on their official website was no longer available. In fact, for the past few months, the Chinese internet has been flooded with negative buzz about Dingy Fang, stuff like illegal fundraising, stock price manipulation, money pooling, and scams. Many believe this recent freefall in Dingy Fang Holdings stock is linked to an announcement they made just 5 days back. On January 10th, Dingy Fang sent out a notice to all its investors, calling it major positive news for all investors of Dingy Fang International Asset Management Group, number 1 of 2024. Signed by the group's founder, Sui Guangyi, the announcement said they were planning to issue digital options and had applied to list on the International Digital Asset Exchange. This meant an enclosure period of 8 months, starting January 10th to September 10th, where investors couldn't pull out their money. They even claimed that listing on the International Digital Asset Exchange could lead to huge returns for investors. Starting February 1st, dividends would be 0.5% a month, paid out quarterly. They promised to sign contracts guaranteeing a 20-fold increase in assets for investors after 10 years. But instead of being thrilled, investors were spooked by this good news. Many feared they'd never see their money again once this enclosure period began, leading to a massive sell-off of shares. And it doesn't end there. Word spread online that hundreds of investors, unable to get their money back from Dingy Fang's financial products, have been protesting at the company's Shenzhen headquarters, demanding answers from the top brass. Adding to the drama, on January 10th, Dingy Fang Holdings announced that Liang Jiehui, their non-executive director and member of the Investor Relations Committee, had quit all his roles in the company, effective immediately. And according to the Hong Kong Stock Exchange, key investors have been dumping their shares since September 20th of last year. Meanwhile, on Chinese social media, screenshots are circulating of what looks like investors discussing how to get their money back from Dingy Fang. There's a growing sense of panic among investors about a looming crisis at the company. A Ponzi scheme. Publicly available information reveals that Dingy Fang previously promoted a variety of high-yield financial products. These offerings included 18% semi-annual interest, a return of $1.82 million after a $1 million investment for a year and a half, a one-time payment of $3.64 million after investing $1 million for 3 years, and subscriptions to original shares for $1 million with a 10-year lock-up period. Investors were promised a one-time payment of $5 million after 5 years and $11 million after 10 years, among others. Despite attracting numerous investors, these high-yield products faced criticism from industry experts who found them unreasonable. The company's promotional materials claimed to have the world's best investment returns, with annual returns never falling below 30% and no reported losses to investors. However, recent events have raised concerns. Information about Dingy Fang's current status is scarce, and its founder, Sui Guangyi, has been linked to deregistered companies. In March 2019, a Hong Kong-listed entity related to Dingy Fang faced suspension and investigation, leading to a name change. The Shenzhen Local Financial Supervision and Administration Bureau issued warnings on February 19, 2023, and November 23, 2023, highlighting risks associated with Dingy Fang, including illegal fundraising, delayed rebates, contract expirations without refunds, and difficulty in cashing out. Regarding the current situation of Dingy Fang's plummeting stock price, Asia Finance posted an analysis suggesting that the company was operating a financial scheme based on real estate mortgages, resembling a Ponzi scheme. Questions surround the company's promised lock-up period and digital options. With significant financing obligations looming, a failure to meet these obligations could lead to defaults in mortgage financing for thousands of houses in the Shenzhen market within months. Another analysis by Mijai Pearl River Delta suggested that Dingy Fang's longevity was due to a Ponzi investment approach. As long as substantial capital flowed in from new investors, it could cover the high interest rates promised to earlier investors. If Dingy Fang were to collapse, the fallout could be substantial, potentially rivaling that of the Zhongzhi Group. This long-standing asset management company in Shenzhen had amassed an astonishing amount of capital, and the consequences of its collapse would be severe. CCP prohibits issuance of 364-day foreign bonds amidst rising local government debt. According to Reuters, on January 8, China's financial regulatory authorities, controlled by the Chinese Communist Party, took action by directing local government financing platforms to cease the issuance of 364-day overseas bonds. This step was taken to address the uncontrolled borrowing by local governments. These 364-day overseas bonds are foreign debts with a maturity of less than 1 year. They bypass the supervision of the National Development and Reform Commission, NDRC, making their issuance relatively straightforward. Many urban investment and construction, city investment, companies consider them a short-term source of critical liquidity, using overseas financing to relieve financial pressures. Urban investment and construction companies function as the investment and financing platforms for local governments. The report indicates that local governments have accumulated a total financing amount of up to $9 trillion through these urban investment and construction companies, posing a significant risk to China's economy. In 2023 alone, Chinese local governments issued at least 27 overseas bonds, all with a maturity of 364 days. Experts argue that this move by local governments appears to be a short-term fix rather than a long-term solution. Lawyer Liang Xiaohua, former chief compliance officer of a mainland asset management company, warns that failure to repay debt upon maturity may lead to defaults, potentially triggering a series of issues, including cross-defaults and high penalty costs. Chinese media reports highlight the substantial expansion of local government debt in China, burdening various provinces with significant debt loads. Fiscal revenues have experienced negative growth, and some local governments have already faced insolvency. In that context, Liang Xiaohua's analysis reveals that at present, local governments in China have limited alternative financing options. Consequently, they have exploited regulatory gaps to issue short-term overseas bonds through financing platforms. He explains that short-term bonds typically have maturities of less than 1 year, specifically 365 days or less. These bonds serve various short-term financing needs, including ultra-short-term financing with maturities of 270 days or less. Short-term financing primarily aims at managing cash flow and is not intended as a representation of long-term investments. For years, most of the funding for local government debt in China came from loans provided by banks and other financial institutions. However, in recent years, banks have tightened their lending practices. Consequently, local governments have turned to various channels such as bank wealth management products, trust products, securities investments, and insurance investments to raise funds. To mitigate the risks associated with local government debt, the CCP introduced a series of measures starting last year. Simultaneously, it tightened regulations related to bond issuance through financing platforms, effectively closing off the avenue for short-term financing. Taiwanese financial expert Huang Shizong adds, currently, China's debt is primarily composed of corporate debt and local government debt. Corporate debt may lead to natural business closures or adjustments over time. However, the issue with local government debt is significant. How do you address this debt? The solution is to prevent it from expanding further. Allowing this platform to continue borrowing without limits will only make the problem worse. Therefore, it's essential to halt borrowing for now and review how to tackle this issue. He believes this will pose a significant challenge in the future. Research conducted by the Chinese Academy of Social Sciences shows that between 2007 and 2011, China's total debt surged from 11.9 trillion yuan to 24.2 trillion yuan, nearly from 1.67 trillion to 3.4 trillion US dollars. Yuan Haixia, deputy dean of the Research Institute of China Qingxin International Credit Rating Company, estimates that by the end of 2021, China's debt had reached 33.6 trillion yuan, approximately 4.7 trillion US dollars, equivalent to a per capita debt of 240,000 yuan, approximately 33,700 US dollars. Moreover, the recurring COVID-19 pandemic over the past 3 years has inflicted additional damage on China's real economy. Since 2023, Chinese real estate companies, trust asset management institutions, and other entities have experienced a wave of defaults. Meanwhile, the property and stock markets have witnessed significant declines, further exacerbating the debt burden on local governments. Huang Shizong states that many local governments seem to be in dire straits. They no longer have access to these financing platforms. Therefore, he anticipates that we will witness numerous local governments grappling with financial pressures, struggling to pay salaries, and experiencing more incidents like this. Since last year, China has witnessed a wave of business closures, layoffs, and rising unemployment, coupled with a widespread issue of civil servants not receiving their salaries. Currently, various provinces are implementing organizational downsizing and reducing the number of leadership positions. Recent poll shows that global attitudes have not yet digested the news on China. Global opinions on China seem stuck in the past and show no recognition of all China's problems. A shock is on the horizon. This is the argument in the article. Recent poll shows that global attitudes have not yet digested the news on China, published January 16, written by Mr. Milton Ezrati, a chief economist for Vested, a New York-based communications firm. According to Mr. Ezrati, public perceptions of China have hardly changed over the past year. This is amazing, given all the ugly financial and economic news of the past 12 to 18 months. China has a very different look now than in this backward-looking view. As the news of trouble gains greater currency, global perceptions will suffer a shock and then change fast. The latest picture of global attitudes comes from a poll conducted annually by the German Marshall Fund of the United States. For years, this group has asked people on both sides of the Atlantic their attitudes toward and expectations about all the major issues of the day, including events in China. This year's survey included a vast number of responses from people in 14 Western countries: the United Kingdom, the United States, France, Germany, Sweden, Italy, Poland, Turkey, Canada, Spain, the Netherlands, Portugal, Lithuania, and Romania. Sadly, the survey does not include Asians, who would naturally be more current on the situation in China and that country's towering economic and financial problems. Still, the results give a good baseline of prevailing public opinion in the West and accordingly signal how perceptions will likely change in the coming months as China's predicament becomes more widely known. One of the most telling things about this recent survey is the persistence, despite the news of China's troubles, of the once common perception that China will soon overtake the United States in global influence and economic strength. Universally, respondents identified the United States presently as the nation with the greatest global influence. However, respondents said they expect that within 5 years, China's influence will just about rival that of America's and that China will surpass the United States as the world's most powerful economy. For years, these were common beliefs and a reasonable extrapolation of trends that had existed for a long time. China had grown at a phenomenal pace and seemed to be getting rich beyond all earlier expectations. That view seems to have persisted. But the past couple of years have interrupted those strongly positive trends. The reality now says something very different about how fast China can make the gains once so widely expected. Now, China faces a dangerous debt overhang, and its pace of economic growth has slowed radically. Exports are falling, and Western investments, as well as trade, are looking elsewhere. It is no longer a question of whether perceptions will change, but how fast the change will come. It speaks volumes to the backward-looking aspect of these expectations that respondents to this survey, especially in Western Europe, feel more strongly about China's coming economic and diplomatic dominance than they did last year. China's recent economic troubles may not be enough to change perceptions entirely, but for people who are paying attention, the news would surely make them less confident. Either the Western Europeans dismiss the past year's news from China out of hand, or they are simply ignorant of what has happened to that economy and its financial system. The latter explanation is more likely the truth. One thing in this survey does fit reality and has changed very little. That is the negative view Westerners have of Beijing's aims and behavior. Though respondents generally advocate cooperation between the West and China, a mere 23% of those surveyed across all 14 countries see China as an economic partner. More than half see China as either a competitor or a rival. The balance of respondents had no opinion. The most negative opinions came from the United States and Western Europe, especially Germany, France, Italy, and Spain. Indeed, the Europeans as a group are even more negative than the Americans, the exact opposite of the more strident rhetoric coming out of leadership in the United States than in Europe. From this assessment, it is hardly surprising that people on both sides of the Atlantic advocate that their governments take a tougher line with Beijing. Since the economic and financial problems evident today will continue to plague China for some time to come, chances are good that the world at large, Asia first and then the West, will become more completely aware of the Middle Kingdom's severe challenges and change their opinions. Next year's Marshall Fund survey will likely show a very different face than this past year's. Respondents will see China as less likely to gain global influence or as rapidly. At the same time, perceptions of China as less a partner and more a rival or competitor will become starker. Apple implements uncommon discount strategy in China to reduce excess stock. The economic downturn in China has had a significant impact on the smartphone market, and Apple is no exception. The tech giant is facing challenges in selling its iPhones, leading to the surprising introduction of a discount program in this market on Monday, January 15th. These discounts are not limited to iPhones alone, they also apply to products like MacBook, iPad, AirPods, Apple Watch, and others. The maximum price reduction is 800 Chinese yuan, equivalent to about $112.30, with discount rates going as high as 7%. This move is widely interpreted as an effort to clear existing inventory. According to Reuters, certain official government departments within the CCP and some companies have placed restrictions on their employees, preventing them from using Apple products. Additionally, Apple is facing strong competition from local Chinese brands such as Xiaomi and Huawei, which offer more competitively priced alternatives. As China grapples with an economic slowdown and a decrease in consumer spending growth, it's likely that iPhone prices will continue to see reductions. Chinese e-commerce websites have already lowered the prices of the iPhone 15 series by 16% since the beginning of the year. These market concerns are also affecting the performance of supply chain companies like TSMC, Largon Precision, and Foxconn, all of which are closely tied to Apple's products. Don't forget to comment in the section below to share your opinions on today's topic with us. If you find the information helpful, please share this video with a friend to watch together. This will be a great source of motivation for our team to produce more and more quality and reliable videos. And also don't forget to like and subscribe to see more interesting topics from China Truths. Thank you for tuning in.